95% of traders lose money. You've probably heard that stat so many times, it barely means anything anymore. But think about it. If almost everyone is losing, that means most people are thinking about the market in the exact same way. And that way is wrong. It's not that they're stupid or lazy or cursed with bad luck. They simply walk into a game they don't understand with a mindset that turns them into prey from day one. In this video, we're not talking about magic indicators or secret chart patterns. Instead, we're going to break down why most traders fail, how smart money actually uses retail behavior as fuel, and what you must change in your thinking if you don't want to be part of that 95%. Let's start with the first problem, the retail mindset. When most new traders open a chart, they all think the same way. Price breaks above resistance, breakout, I have to buy. RSI is oversold, reversal is coming, I'll go long. Big bullish candle closes. Finally, confirmation, now it's safe. It feels logical, it feels textbook. But the market doesn't reward what feels safe. In fact, those obvious levels and obvious signals are often where bigger players are quietly waiting to offload positions or build new ones. While most retail traders are excited by breakouts and confirmation candles, professionals are asking a different question. Who is trapped here, and where is the liquidity? The problem isn't tools like support and resistance, RSI, or candlestick patterns. The problem is using them without context, as green light, red light signals, instead of pieces of a larger story. When you think like the herd, you naturally trade where the herd trades, and usually get stopped exactly where the herd gets stopped. Price doesn't move because you're right. Price moves because someone bigger than you found enough orders to transact. Imagine a large player wanting to buy a huge position. They can't just smash the market buy button. That would push price up against themselves and destroy their average entry. They need liquidity. Liquidity is simply other people's orders, stop losses, take profits, breakout entries, sitting at certain price levels. Where does that liquidity usually sit? Under obvious swing lows, where everyone tucks their stop losses. Above clean equal highs, where breakout traders place their buy stops. Around textbook indicator signals, where retail traders gather and react in the same way at the same time. So when you see price suddenly spike below a low before reversing, that's often not random volatility. It's a liquidity grab, the market dipping into a pool of sell stops so larger players can buy from panicked sellers. If you don't understand where liquidity is, you're not trading the move, you're feeding it. Even when traders start to understand structure and liquidity, many still lose for one simple reason. Their emotions drive their decisions. FOMO pushes them into trades at the very end of a move. Fear makes them close winners too early and hold losers too long. Overconfidence makes them increase position size right after a big win. Doubt keeps them frozen when a valid setup finally appears. They think they need a better indicator. In reality, they need a better relationship with uncertainty. The market is a probabilistic environment. No setup is 100%. Losses are not personal failures. They're the cost of doing business. The danger comes when you respond to losses by constantly changing your strategy, chasing random trades, or trying to make it back quickly. Without a defined system and pre-committed rules, the chart becomes a mirror for your emotions, and the market is ruthless at monetizing emotional decisions. Most traders are obsessed with the surface of price. They zoom into single candles. Look, a hammer, it must reverse. Engulfing bar, trend change. Candles do tell a story, but only inside a bigger context. A bullish candle in the middle of nowhere might mean nothing. The same bullish candle that forms right after a sharp stop run below a major low during a high liquidity session can mean a lot. The real questions are not, what is this candle called, but where is this candle happening? Did price just sweep a key high or low? Are traders trapped on the wrong side here? Is this move heading toward a clear pool of liquidity? Without context, you're trading pictures. With context, you're reading behavior. Now let's talk about process. Most losing traders don't actually have a process. Their routine looks like this. Open chart, scroll around, see something interesting, take a trade. Move the stop loss after entry because it just needs room. Watch P&L tick up and down. Close the trade based on fear or greed. That's not a process. That's reacting. A professional trader approaches the session differently. Before the market even opens, they know which markets they'll watch, where the key daily and weekly highs and lows are, and where obvious liquidity pools sit. They build scenarios. If price sweeps yesterday's low during London and rejects, I look for longs. If we run above last week's high and stall, I look for signs of trapped breakout buyers. When they finally enter a trade, they already know their entry, their stop loss, their risk per trade, and their target area. No guessing mid-trade. No moving the stop just this once. They're not trying to predict the future. They're executing a probabilistic plan. So how do you move from being random and emotional to having a real edge? Step 1. Pick one framework and simplify. Stop hopping from one strategy to another every week. Choose one structured way of reading the market and commit to it for a meaningful sample. 50, 100 trades. Define your time frames, how you mark key highs and lows, and what a valid setup actually looks like for you. Step 2. Trade location, not just signals. Instead of asking, is this a bullish pattern? Ask, is this the right place on the chart? Has price just swept an obvious high or low? Is there a clear pool of stops just above or below? If the location is poor, even the prettiest setup is trash. Your edge isn't just the pattern. Your edge is the pattern in the right place with the right context and the right risk. Next, you need to think risk first, profit second. You don't control how far a trade will run in your favor. You do control how much you lose when you're wrong. That means risking a small, fixed percentage of your account per trade. Placing stops where your idea is clearly invalidated, not where it feels comfortable, and accepting that many small losses are the price of staying in the game. Your first edge is survival. Then comes refinement. And that's where journaling comes in. Most traders never review their trades seriously. They remember the pain, not the pattern. If you log screenshots, setups, emotions, and outcomes for every trade, patterns will start to appear. Which setups perform best? Which times of day hurt your results? How often you break your own rules? That's how you turn trading from a random experience into a craft you can actually improve. Let's bring it all together. Most traders fail not because markets are impossible, but because they approach them with the same mindset as everyone else. They chase signals without context. They don't understand liquidity, so they become liquidity. Their emotions override their rules, if they even have rules. They focus on candlestick names instead of market structure. And they trade without a real process, reacting to every tick. If you want to stop trading like the 95%, you must think difficulties. See the market as a hunt for liquidity, not a collection of random price bars. Trade locations and behaviors, not just patterns and indicators. Build a simple, consistent framework and execute it with discipline. Control risk first and use journaling to refine your edge over time. You don't need to predict the future, you need to understand the game. Choose your spots carefully, manage your risk, and let probability do its job. If this helped reframe how you see trading, let me know in the comments what you struggle with most right now. Is it discipline, entries, exits, or something else. And if you want more deep dives into how market behavior really works, make sure to like the video and subscribe. Trade smart, trade with context, and stop volunteering to be the liquidity.